Welcome to the Stock Spinoff Investing Podcast, where we talk all things spinoffs. My guests and I may maintain a position in the securities that we discuss today, and this podcast is for informational purposes only and should not be relied upon as investment advice. Hi, everybody, and welcome to the Stock Spinoff Investing Podcast. I'm happy to have Colin King of Circle City Capital back on the podcast. He's the first guest that's come back from round two, so I really appreciate Colin, you coming back on the podcast. This time, we're going to be doing a little bit different. Last time Colin was on the podcast, we talked a little bit about his background and how he's built his holding co company, but we spent a lot of time just focusing on a single name, Magnera. Today, we're just going to rattle off a bunch of spinoffs right now that look interesting. The market's down about 10% from its all-time high, and it looks like there's a lot of interesting stuff to do. So I'm going to talk about some names that I think are interesting, and Colin's going to do the same. And hopefully it's enjoyable and helpful for everybody. Colin, does that sound good to you?
I love it. Yeah. I mean, the markets are cratering and the watch list is growing, and there's lots of spins and former spins that look pretty interesting right now. So I like it.
Awesome. Let's do it. Okay. So first name that I want to talk about is IAC Inc., which trades under the ticker IAC. And this is a name that I've actually owned for the past 3 years. It's been, or maybe 2 years. It's been very, very frustrating. One of my most frustrating stocks in the portfolio. The reason why the basic pitch, and Colin, I know you follow the name, so I want your questions and I want your comments as well. But the reason why I think IAC is so interesting is if you follow spinoffs, which obviously I do, IAC is a spinoff machine. So since 2005, the company has spun off, by my count, 7 names. So Expedia, LendingTree, Interval Leisure Group, HSN, Ticketmaster, TripAdvisor, Match, Vimeo. Actually, so that's 8. And then they just recently announced that they're going to be spinning off Angi at the end of this month. That's going to happen really quickly. So basically, the sum of the parts story, and you can get into trouble with some of the parts stories because you never know when the value is going to be unlocked, and things can trade at a massive discount to the sum of the parts value for a very long time. But the beauty of IAC is that they spin off and they monetize their assets. So my sum of the parts valuation, it really depends on where Angi's trading and where MGM is trading, because those stocks represent a decent percentage of my fair value. But just assuming that those stocks are fairly valued, I get about, depending on the price, between $75 and $85 per share of fair value for IAC. And so that's fair value. The stock's trading, I think, at about $46 today. So some pretty significant upside. Now, I think the next big question is, okay, but why now? Like, why? This has been the thesis for the past 2 years. Like, why is now a particularly interesting time to look at IAC or own IAC? And I think there are two things from my perspective. So first of all, as I previously mentioned, IAC is going to be spinning off Angi. And so Angi is Angi Home Services. If you search for on Google, clogged drain or need a deck rebuilt, Home Advisors or Angi will be some of the first names and first companies that pop up and try to get your business. So that's really what their business is. It's a marketplace where they try to connect homeowners like me or people that need home services to home service providers. Now, one thing that's held me back, like maybe 5 years ago, I wasn't as excited about IAC. And one of the big problems was that Angi was such a large percentage of IAC. You really had to bet on Angi working for the stock to work, at least in my opinion. But today, that's not the case. So Angi only represents 16% of IAC's market cap currently. And I think that Angi actually looks interesting right now. It's trading kind of at a 10% annualized free cash flow estimate. The former CEO of IAC is actually going with Angi, going with the spinoff. So that suggests that there is a good opportunity to actually grow revenue. And you think of just like a 10 times free cash flow multiple, that's that usually you don't usually see that multiple with a marketplace business. I get it that Angie has had some issues in the past, but it seems like they've worked through some excess that was induced by COVID, and the business looks really interesting. So that spinoff is going to happen at the end of this month, at the end of March of 2025. And so at current prices, you're going to get about a 16% dividend, I call it.
Yeah.
And that is that's pretty interesting. And then the other interesting thing is that Angie, I think the valuation is cheap to begin with. But then the other nice thing is that if you did like Angie, why would you buy it right now? IAC is going to spin off 85% of the business. There theoretically is going to be tons of massive selling pressure. Why would you bother buying it? So there's no natural buyer right now for Angie. I think the stock looks cheap, and I think the outlook is interesting. And then I have one other reason why I think IC is particularly interesting today. But before that, I'm going to pause to see if you have any thoughts on
Yeah.
IC or Angie
Yeah.
before we move on.
Yeah, it's interesting, and MGM is what, like half the market cap or something like that, and then 16% for Angie, and then they own a big stake in Turo, and then they own the Dotdash Meredith business. And when I first got interested in IAC, I owned shares of Meredith. So
Yep.
Meredith bought Time Magazine, and like that stock cratered, and they were cleaning it up, fixing it up, and they had success with that. And then IAC came in and bought them as they were kind of coming out of that acquisition integration. And I actually really like that business. And then the combo with Dotdash made a lot of sense. But I think that business is kind of underperformed since when they originally bought it, 2021, right? Like COVID spike and everything, and it just hasn't gotten to what they thought they could do with it. I actually took the stance that IAC is interesting if you strip out MGM, strip out Angie, and you just say, hey, I own this stub. I got a little bit of net debt. I got this Turo stake, which they will eventually get rid of, right? Like Turo's been trying to come public and they even filed docs for it. So like, eventually you'll get shares of Turo most likely. And then you just got this collection of internet media businesses that kind of looks like Ziff Davis, honestly. Like the stub actually looks and feels like that business. I find that kind of interesting because that's trading at a similar, I don't know, it depends on what you think Turo is worth. But maybe it's what, like 4 or 5 times EBITDA or something like that you're getting the stub piece for. MGM, I don't know. I would actually rather just own this without MGM or Angie because I look at Angie and I think about Yelp and it's probably trading like right where Yelp is trading. But Yelp, their service business that connects people with like plumbing repair type stuff, that business is growing a ton, and Angie is kind of trickled lower from a revenue standpoint. So I don't know. I'm thinking those two businesses will just get lumped together, and that 10x free cash flow is probably what it deserves to trade at for a while, right? Because Yelp is growing revenue and cheaper than that, and Angie isn't and has a little bit of debt. So I don't know. I would rather own stub IAC and just get exposure to that Dotdash Meredith business and see what they can do with that.
Yeah, I 100% agree. I mean, I think that Diller, like you heard, Barry Diller got back on the conference call for the first time in a while, super energized. He's super bullish on MGM. He thinks that stock is just incredibly undervalued. And I have I have some smart friends who agree and own MGM. And I totally get that investment case. And MGM looks really cheap. They have their own sum of the parts story. Like they
Yeah,
have BetMGM, they have MGM China, and then they're buying back a ton of stock every year. But
yeah.
you're never gonna, when you're a company like IAC, you're never gonna get credit for owning another publicly traded company. You're gonna trade at a discount because
Look at Liberty
investors.
Global, right? Yeah.
Exactly. Exactly. Investors, what they want to pick and choose what they own. They can decide to own MGM or they can decide to own IAC. So, yeah, I totally agree with that. The other thing why I think it's really interesting right now is because, so one big frustrating thing with IAC has been that it hasn't been buying back stock.
Yeah.
And they every quarterly letter they come out and they say, "Hey, we're trading at a massive discount. The market value's telling us that we're worth zero or negative."
And
Ha
then do
ha
nothing.
ha! That could never make sense. And then it's like, well, you didn't buy back any stock, so like, what are you doing? Like, what are we doing here?
Yeah.
But that has changed recently. So recently, I think 2 days ago, IAC filed an 8K, and they basically said that they upped their share repurchase authorization by another 10 million shares. And I think there's, I think IAC has about 80 million shares outstanding. So I think that's about 12% of shares outstanding that could be repurchased. And then the other nugget that I stumbled upon today, just looking over the latest releases, is that as of 12/31, IAC had 3.7 million shares remaining on its share repurchase authorization. And then just connecting the dots to the most recent 8K, IAC increased its share repurchase authorization by 10 million. And then they said, but in total, we have 10.2 million shares share repurchase authorization. So that implies that they bought back between March 30 or January 30, December 31st and March 14th, 3.5 million shares. So
Big
that's
chunk.
like a pretty aggressive and healthy clip, which I don't think is fully appreciated by the market and makes sense. It's like, hey, if you have such high conviction in the undervaluation, which I do, like buy back stock. You should be buying back stock hand over
Totally.
fist.
My big challenge with these some of the part stories, like I looked at Vivendi and that stock's actually started working, but it's like they don't really own any operating businesses, right? So there's no like cash flow to the parent company unless you sell stuff that you own. So I don't know if you've done the math. I haven't done it, but I don't know if you've done the math on, if you strip out Angie, strip out MGM, does the underlying business with the debt that they've got, like, does it actually generate free cash? One of the big hangups I've always had is that they have a ton of corporate overhead expense in this business to manage this portfolio. And they got a decent amount of debt on the Dotdash business. And they carry this huge gross cash position. And I'm guessing it's because they just look for investments and deals and stuff like that. But it's kind of a weird holding company structure where, Angie's consolidated, so you can't really rely on the face of the financials. But if you strip out Angie and if you strip out MGM, because those aren't, they don't get that cash coming into their bank account, like what are they actually generating? So I wonder if it's a situation where they may want to buy back stock, but they just don't have that ongoing operating business generating cash flow for them to deploy unless they use cash on hand or sell some stuff. You know what I mean?
Totally. Yeah. So yeah, MGM, obviously they don't get the cash flow from MGM. Angie, they don't get the cash flow from Angie. Dotdash
Correct.
Meredith, that business is improving. So that business should generate some
Totally.
significant free cash flow. Then they have Turo, which again, they have about a 30% stake. That doesn't generate free cash flow. Care.com, they have Care.com, which is the other business that, so it's basically Dotdash Meredith and Care.com. And
Yeah.
then they have some smaller businesses which could generate a little bit of free cash flow. But yeah, you're right. And then one of the knocks on IC is that just like corporate costs have been like so high. So it's
And
like
they've whittled the portfolio down. It's like at some point you got to right size that if you're
and
jettisoning.
that's what they've said. They said that they're going to do that, and hopefully they actually execute on that. But that's one of the other knocks that the corporate costs. Like I in my sum of the parts valuation, I can walk through it. I assume a negative $600 million just due to capitalized corporate costs. I'm assuming a six times
Yeah.
multiple on annualized corporate adjusted EBITDA loss, but it's significant. I mean, it's
Yeah.
like it's a real number.
Yeah, yeah, yeah. Anyway, that's like the one piece where I'm like, I really would love to see like what's the core underlying cash flow, and like that would help me value that side of the business, like what they wholly own, and then I can come up with my own number for, or just use the market multiple, or sorry, market trading price for things like MGM and Angie. Although Angie will be gone soon, and Turo is kind of a black box. Although we've got better information now, and then the value on that's probably higher than when the last round they did on that business. Yeah.
Totally. Yeah. I mean, that's a really good point though. How much cash does the underlying business generate? So yeah, I'll spend some more time. I think it is kind of to your point, it's a little bit marginal right now because Dotdash Meredith has been a little bit of a turnaround situation, and then Care.com kind of a similar situation. So maybe that's part of it. And hopefully the fact that they bought back 3.5 million shares in, a little bit over two
Yeah.
months, maybe that points to the fact that actually cash flow generation is actually going to ramp up.
Yeah. but they have a huge cash balance. Yeah, I'd be curious what they do when they eventually break up Angie and kind of change the management structure because I want to say at the holding company level they carry a billion plus debt for the Dotdash business, but like a billion plus of gross cash, right? So like
Yep.
I mean, they could just say, hey, let's eliminate a huge slug of interest expense, right, and just use cash to pay down debt, but they haven't chosen to do that. So I don't know. I wonder what they're going to wind up doing capital allocation wise.
Yeah, one thing that kind of worries me is that there's been articles in the press. Hey, we're hunting for a deal.
Halting.
Like
Yeah.
their deal is like I'm hunting for a deal, and I'm like, dude, you're 85 or however old you are. Like, come on, man. Like he's like wants to buy Paramount. I'm like, oh. So that's like the one thing that makes me a little nervous about the situation. But it seems like they backed off that a little bit, and then they've kind of leaned into share buybacks. I'm
Yeah.
gonna I'm gonna run through my sum of the parts valuation real quick, and then
Let's
if you
hear
have
it.
any questions, we can chat about that, and then I'd love to kind of move on to
Other
what you think's
ideas. Yeah.
interesting. So cash. So I'm basically backing out the cash on Angie's balance sheet. So I have them. IC has about 1.4 billion of cash. They have about 1.5 billion of debt. That's backing out again the Angie debt. Angie, I valued at about 650 million bucks. That's just IC
Market
owns
price.
425 million shares.
Yeah.
MGM is worth about $2 billion. To your point, IC's market cap is 4 billion, and MGM's based on its current share price is 2
Yeah.
billion. Um, and then Dotdash Meredith, I have it valued, and I'd be curious to what you think about as a right valuation there. So, um, I have it valued at about $2.7 billion, which I think is about 8 times their EBITDA guidance for
Yeah.
2025.
Yeah.
Curious, what do you think that business is worth?
I yeah, they were originally saying that they thought that was like a $450 million EBITDA business, and I think they're like just shy of 300 or hitting around 300
Yep.
in the coming years. So they're short of what they thought. I was just looking at Zip Davis the other day and just did a write up on that one. And Zip Davis, which is like kind of similar to IAC, right? These old school internet digital media businesses. It's a little different, but like internet publications, subscriptions, ad dollars, that kind of thing. And that business is trading at less than 4x EBITDA, and it has a pretty clean balance sheet. And I'm like, oh man, like so if 4x is the number, then I don't know, Dotdash at 8x would be tough. I always thought that the Dotdash Meredith business was pretty good company. Probably would generate a ton of cash, like if it had the right capital structure and just stood on its own. I don't know how much of the corporate costs is should be allocated to that versus like unallocated true holding company corp
Yep.
costs. Um, so I don't know. That seems pretty fair to me. I mean, Meredith, when they were was the TV station business and then the media business, right? And they split those two things up and sold both of them. I thought that business was worth probably about 8.5 times when I originally got involved in it. So I don't know. That might be a little high, but it's probably pretty fair.
4 times doesn't cover the debt, so that would be a problem.
No, yeah,
Yeah, and then to your point, so I think the initial guidance was like 450 million of EBITDA, and right now, so last year they generated about 300 million of EBITDA, and then this year they're guiding to 340 at the midpoint.
that's not
So business is growing,
back on the uptrend.
doing good things. And then Turo, so I have Turo. So Turo, I have it valued at about 3 times revenue. So the Airbnbs of the world, trade at 8 or 9 times revenue, I think. So this is a marketplace business, the leader and the market. I don't know if you've used Turo, but it's a cool service where basically instead of renting a car, you can just pick up a car at the airport from somebody,
Pretty
and
good.
it's a pretty cool service. It's like Airbnb but for your car.
Yeah,
So that's I have that at 3 times. IC owns about I think 30% of that business, so that's worth about 900 or $1 billion. I have care.com. I'm just holding it at $500 million. That was the acquisition cost. That works out to about 10 times 2025 guidance.
yep,
Um, the Vivian Health is just like kind of a minority startup that they've invested in. They own 75%. I'm holding it at its, the last valuation round was $300 million dollars. They have some real estate. Search is like a business in secular decline.
yeah,
Um, I've capitalized corporate costs at basically negative $600 million. So that gets me, those are like the big things. That gets me to about a $7 billion kind of fair value. So obviously significantly above where the stock's currently
Yeah.
trading.
Okay, I think that's a good take. My approach was just to work the other way and just say, what do I think is reasonable or what do I think is cheap? And so if
Yep.
you take 4 billion market cap or whatever it is, right, call it 4 billion-ish, back out the 2 billion for MGM, back out the 600 some million for Angie. I don't know that Angie's worth a whole lot more than that, but whatever. So 2 billion, 600 million, and then whatever the Turo stake is, even at the last round they did, that's something like $400 million for their stake. You get to a pretty low EV, and on that EV, they gave guidance. It's like 250 million or something of EBITDA net of corporate costs and everything. Just bake it all in. So you're basically getting the company, the stub pieces for like 5 or 6 times EBITDA, which to me is pretty cheap and like really low hurdle for all the other stakes that they own. So like no credit for Turo having a massive valuation, which would all be positive. So I look at it and I'm like, yeah, you're getting Dotdash Meredith and a collection of other stuff for pretty low multiple.
Yep. Yeah, I think that's a good way. I think that's a great way of thinking about it. And then I think the other nice thing is that there's just kind of asymmetric potential. Like Vimeo has been a disaster since it was spun out, but it was like for a while there, it was shooting to the moon, and that really drove IAC's stock price up. So similar thing could happen, with Turo or with maybe, Care.com or Vivian or some other business that they're not even talking about, where you could have kind of the asymmetric rocket ship potential and the stock trade up. So yeah,
Yeah.
I think that totally makes sense. Any other thoughts on IC, or should we move on to kind of what
Let's,
actually I
let's,
have another name that I want to cover,
let's hear it. Let's hear it.
but any other thoughts on IC before we move on?
Now, other than it's interesting if you stub it down. Yeah. Yeah.
Okay.
Yeah.
All right. Well, I don't want to spend too much time. I want to get to your stuff, but the other name that I think is interesting is Sunrise Communications. So the basic pitch is this is a spinoff from Liberty Global, and Sunrise is the number two telecom provider in Switzerland. They're behind Swisscom, and then Salt is the number three provider. Switzerland telecom market is very stable, not much growth, a little
Super
bit of
mature.
pricing pressure, but there are three providers that basically control the market, and so it's a pretty rational
Yeah.
market. The thing that's interesting and the thing that got me interested and the reason why I thought that this spinoff would unlock value is because prior to the spinoff taking place, Liberty Global said, "Hey, Sunrise is going to pay a 333 Swiss franc dividend." And so if you run the math and you assume a reasonable dividend yield, it was clear when this transaction was announced that the transaction would unlock value.
Yeah.
And this is a play that I've used in other spinoffs. For instance, Contour Brands was a spinoff from VF Corp, and the
Mhm.
Form 10 disclosed that they're going to pay like a $2.50 dividend. And
Yeah.
so once Contour Brands started trading in the regular way market, it sunk like a rock. And then you could eventually buy it at like an 8% implied dividend yield, whereas all the apparel peers, the highest dividend yield was like 3%. And
Yeah.
so once that dividend was actually declared, like the stock shot back up. We saw a similar thing when Prudential PLC spun off
Oh, yeah.
Jackson Financial. Jackson Financial said, "Hey, we're going to return a ton of cash through dividends and buybacks." I just assumed half of the return of capital would be dividend, and you could get to like an implied dividend yield of like, again, it was like 7 or 8%. And then when Jackson reported their first earnings results and they said, "Hey, we're going to do what we said we're going to do. We're going to pay this very sizable dividend," the stock reacted very favorably. At the time, Jackson was paying like an 8% dividend yield, whereas Bright House Financial paid zero dividend. And then there was another annuity or variable annuity provider that paid a very small dividend. So the relative difference between the dividend yields looked really, really interesting. And
Yeah.
that's been, I call it kind of the dividend as a catalyst trade where the dividend's announced and then the
Yeah.
stock re-rates higher. And so that's kind of what I'm thinking might play out with Sunrise. So basically Sunrise, they announced results the results at the end of February. The results from my perspective were consistent with what they had provided during the analyst day this fall.
Yep.
The stock. They said, hey, we're going to pay out this dividend. It currently works out right now on the math to like a 8.2% dividend yield. The next closest, so Swisscom pays about a 4.2% dividend. And so the thought process is now the dividend has not been declared. It is showing up in Bloomberg, but it has not actually been declared yet.
Yeah,
And so I actually thought once they announced the dividend per share that the share price would react,
people
that
get
the
excited.
stock would jump higher. That hasn't happened. But what I'm thinking may happen is that the dividend needs to be approved at the shareholder meeting on May 13th. And then
Mm,
very shortly after the dividend is going to get paid out. I think the approval of the dividend is basically a formality. But
yeah.
my thought is that once people see, hey, this company's paying an annual dividend that's about an 8.2% yield, the stock will react higher. So that's my thought process.
Yeah.
Sunrise used to be a publicly traded company before Liberty bought them. It used
Yeah.
to trade at a dividend yield of between 5 and 6%. So at a 6% dividend yield, the stock's over $60. It's trading in the low to mid 40s right now. So you could see a pretty significant re-rating. The one caveat is what's more important, EV to EBITDA or dividend yield.
Yeah. Yeah.
So it does not trade. I think it's a little cheaper than Swisscom right now on an EV to EBITDA basis. But the real glaring difference is on the dividend yield. And so that's kind of what do Swiss investors care about? Do they care about the dividend yield or do they
Right.
care about
The Swisscom is like
the
has super
valuation?
clean balance sheet, right? Like it's got pretty minimal debt, and both of those are really stable. I call them like no growth businesses, right? I mean, they're like haven't grown in like a decade or something. And then Liberty put a bunch of debt on it, right? So they're running like the Liberty balance sheet playbook with it, so to speak. So yeah, I don't know. It probably deserves a 6% or higher type yield, but yeah, I could potentially get behind that thesis. I just look at it, I'm like, all right, you got a no growth business with a levered balance sheet. They're going to pay this dividend, and dividends to me on levered companies leave the business capital constrained, right? You're committed to the dividend, and so now you only have this smaller sliver of cash available for other use cases. And if you've got debt, and granted it's a stable market, but then if you think about debt, like debt to free cash, which I don't, and nobody looks at that, nobody thinks about it that way.
Mhm.
Like, yeah, they will never be able to really chip away at that leverage balance once they commit to that dividend. So I don't know. It probably deserves to trade at a premium, or sorry, a discount to the Swisscom yield, because Swisscom has a super clean balance sheet and it's also
100%. Yeah.
pretty cheap. But I don't know, somewhere in the middle probably makes sense. And maybe it's just a function of it's an unseasoned business, and people need to get more comfortable with them hitting results and reporting and paying it consistently, right? Like, I don't know, the head fake is always what kills these spin-off stories. They
Mhm.
do a poor job of managing expectations and managing guidance coming out of them. So yeah.
Yeah, totally. Yeah, and I don't know if this is a name that I necessarily want to own forever, but
Right. Yeah.
it seems like it's a play where it's like, hey, we could see a really nice sharp re-rating once this
Very
dividend is
clear.
actually paid out.
Yeah.
And if not, maybe we move on. But it's kind of like it seems like there's little downside
And it's a stable
to that.
business, right? Like you know that the business isn't going to fall apart on you overnight. Yeah.
Exactly. Exactly. So that is yeah, that's kind of the pitch in a nutshell. But let's talk about what you're looking at.
Oh man, I got a decent amount of stuff on my list. I feel like I don't know when a spin stops becoming a special sit, right? Like how long it has to have been spun, but I feel like a ton of former spins look pretty interesting recently. The Wholesome, the cement spin, the U.S. business, that's pretty interesting. Stars is coming up soon, although I kind of want to keep that one to myself. I don't really want to talk about that one. Comcast, I'll probably take a look at that spin when that comes, just because it's an industry that's so hated. But on my list, the former spins, the two that I think are pretty interesting right now, the NCR Voyix, VYX is the ticker. They sold this software business, went from pretty significantly levered to like not levered at all. And they've been really mum on what they're going to do with free cash going forward. So I'm like, oh, that's a capital allocation inflection story that looks pretty interesting. They got a great multiple for that software business, and now the stub is trading at like I don't know 5 times EBITDA or something like that. The Havas spin from Vivendi also looks pretty interesting. It's done nothing since they spun it, and they reported results, and the results were, I don't know, better than what they were last year, and they guided to a pretty good set of numbers for next year. I just think the free cash or backing into cash flow and free cash flow for those European businesses is just a little wonky to me. Like it's misleading to just say, here's what operating cash flow is on the cash flow statement because IFRS has different rules and treatment for stuff. So like, I don't know if you pull in some of these other items from different areas on the cash flow statement, it's not as cheap on a free cash basis, but that one also looks pretty interesting to me. So
I'd love to talk about NCR because I haven't really been following that one very closely. And then I'd like to talk about Havas too, just because I
yeah,
agree. And I think they reported results. They announced a share repurchase authorization for up to, I think, 10% of shares outstanding. Somebody told me they're like, yeah, but I don't know how much cash they have to buy back shares, like how much free cash they're going to generate. So would love to get your thoughts on that. But yeah, maybe start with NCR.
yeah, NCR. So they split, man, I can't remember when that was, 2 years ago, maybe. And they split their ATM business, which is
Right.
NATL. That's the ticker on that one. And then VYX is their like POS hardware and software business.
Yes.
So
Yes.
retail, restaurants, right? And I think the market probably looks at that and says, well, that's a crummy business compared to Toast and all those other companies that are out there. But NCR is mostly enterprise. So like deploying to a huge number of locations, right? So they're not really SMB focused. But I don't know. I don't know that I have a super strong opinion on that business model versus other companies that are out there. But they had this digital banking software company at the time they spun, and they sold it, and they sold it for a software multiple. They got a really good return on that. So that closed and settled, and they got the cash for it. And they went from, I don't know, like just shy of 4x levered to like 2x levered, maybe a little less than that, something in that territory. And you're like, oh, wow, okay. Well, now they've got, it's 10% free cash flow yield ish in that territory, maybe even lower because the stock is just still drifting, right, with the rest of the market. And they haven't really said anything about, okay, leverage is below our target and we have all this free cash that we're still generating. Like, what are you going to do with it? Are you going to start buying back stock? Are you going to look for tuck-in acquisitions? Or what are you going to do with it? And they haven't really said anything yet. At least I think. Maybe I haven't read the last quarterly call close enough, but I just find that interesting when you have like a step change function in leverage, right? You go from call it 4x to 2x, then all options are on the table now with your free cash, right? Because you don't have to commit that to the balance sheet anymore. So I just find those situations to be really interesting. Like I owned some shares of Molson Coors Tap, and they went from 5x levered to 2x, and it took them 7 years to get there. But they got there, and their leverage target is 2.5 times. They're at two. So they're like, hey, everything's fair game. We're going to buy back stock. We're going to take the dividend up. We're going to look at little tuck-ins. So I just find those inflection stories to be really, really fascinating. And I feel like VYX, they could be on the cusp of that. So I'm not as close enough to the industry to know, like, is it a quality business that you want to own for
Right.
years? But might be a good 2 year, like, hey, get some momentum going here, right?
And you said it's only trading like 5 times EBITDA, the
Yeah.
stub.
Oh yeah, yeah.
And
They gave
has the sale closed of their software business?
yeah, it's done. So if you
Yep.
pull up the last quarterly earnings report, I don't have it in front of me. They gave guidance on, okay, if you strip out the software at the time they announced the sale, they said, hey, if you strip out the software business and the performance from that, here's what the stub looks like. Then they reported Q4 results and they said, hey, our guidance is basically right in line with those numbers. So it's not like they misjudged what it would look like when you strip that business
Right.
out, which I like, right? I like
Right.
that. Yeah.
And so as you understand it, their remaining business is just kind of a point of sale enterprise. Like, do they have like customers like McDonald's and like
Yeah.
restaurants like that?
Yeah. They got us a big slide deck that kind of walks through the different
Yep.
customer profiles. One piece of it that I think had been wonky in the past. So they make like those big self-checkout things that you see at the grocery store, like the hardware that goes into that. And
Right.
they formerly manufactured that in-house. And then just recently they announced a partnership where they're going to get out of that manufacturing business,
Hmm.
and they're just basically going to be like a manufacturer's rep essentially. They'll collect a commission for deploying it, and someone else will take the actual manufacturing and management, which I think is a brilliant move because you smooth the results of that, right? Your revenue will come down as you unload those big ticket hardware sales. But like the results will be smoother, the free cash will be smoother throughout the year. So to me, that sounds like it was a no-brainer move. And that's in addition to the software sale. Yeah.
Yeah, it seems like a really, really positive. It seems like they're just making smart, rational decisions.
Yeah.
I mean, the other thing is, I mean, it kind of begs the question, like, is this business like how big is it on a market cap or enterprise value basis? Do you know offhand?
Yeah. Call it like a billion and a half, maybe.
Oh, really? So it's bite size for private equity. Like this would be a
One
great
point eight.
PE
Yeah.
target.
Oh, totally. Absolutely.
I mean, you
Absolutely.
look at like an underlevered balance sheet, a multiple or
Offer
a business that's
exposure.
not getting a growth multiple, but it's probably going to generate a lot of free cash flow. It's like, if
Totally.
you're paying a high interest rate, take it private, lever it up, and just use your cash to delever and then accrete
Totally.
value to the equity holder. So that sounds really interesting.
Yeah. 1.8 billion is market cap.
I mean, it
Yeah.
also seems like an activist, like right for an activist. Like, hey, what are you doing with this cash? You're underlevered. Like, so yeah, that's interesting.
I want to say there might be one in there.
Yep.
Engaged Capital might own a big stake, but
Engaged Capital, you said?
yeah, yeah. What is that? Glenn Willing's company?
I feel like I'm seeing Engaged Capital in a lot of like good kind of juicy situations.
Cheapish. Yeah.
Cool, man. Well, yeah, maybe unless there's anything else on NCR, I gotta look at that one. I haven't looked at
No,
that one in a
take a
long
look.
time.
I'd love to get your thoughts. Yeah, take a look at it.
Yeah. Let's switch to Havas. So I guess, when I look at it, if you just, do the valuation versus the other global advertising peers, it looks very cheap, but I admit that I haven't done like the IFRS adjustments to make sure that I'm not missing anything. So would love to get your thoughts on that. And then also like, do you think the business is actually going to generate? I know you've thought about those adjustments a little bit. Is the business actually going to generate like cash at the end of the day? Like real
Yeah.
free cash flow?
I think they're generating cash and they run a net cash balance sheet too, which is nice. I think what do I have it at? They guided to like 360 million in EBIT, right? They use EBIT as kind of their earnings marker.
Yep.
So I think it's trading at less than 4x EBIT based on the
Less than
2020,
what?
less than 4x.
That sounds crazy.
Yeah. So, but then if you go pull up the cash flow statement and say, let's walk from EBIT down to free cash, IFRS, they put things like your interest payments on debt down into the financing cash section, right? And then like lease payments for leases go down to that financing section. And then because it's an ad agency business, there's tons of non-controlling interest. So they come in, they acquire, they don't acquire 100%, keep the partners on, and then they buy back those non-controlling interests over time. But they also have to send dividends to those non-controlling interests. So that winds up eating into a decent amount of cash, just like monitoring and managing that non-controlling interest portion. So I think it's a little misleading to say, oh, I don't know what they tout free cash flow as. I just am looking at my numbers because I just keyed it in after they reported 2024 results. I got about 107 million of free cash, which is like 11 cents a share on a $1.50 stock. So it's not like insanely cheap, and that's pulling in maybe some extra stuff. Like I don't know if that fully reflects the new balance sheet that they've got, right? Post spin and everything. So there might be a couple of moving pieces to that, but like they don't really turn a ton of that EBIT into free cash after you factor in some of those other things. I think that's maybe my beef with it at the moment.
And then I think they're going to pay. I think didn't they commit to pay out a decent dividend as well?
Totally. Yeah, totally. And I think that'll be a meaningful yield. I can't remember if they said like a 40% payout ratio or something like that. Yeah, I want to
Yeah,
say that.
I think it was something like that. I want to say like, 40. I don't think it was, I want to say, I don't think it was 60, but I think like 40, like pretty meaningful.
Yeah, yeah,
Um,
I think that's right. I haven't done the math to see like what their basis for that 40% of, right? What are they using as that other part of that fraction?
right. Yeah, I mean, that's a good, yeah, that's like, what cash do you have to really pay out? And you're going to pay out
Yeah,
40%
yeah.
of that.
Yep. Like what's the multiplier?
Yep.
I guess the other piece that I thought was interesting is they have done a pretty good job of like keeping revenue growth and EBIT margin growth going, right? And so they're guiding to pretty consistent expanding revenue and expanding EBIT margin over the next few years. So if you believe they'll achieve that, then like it's got a nice outlook, I guess you could say, from like today to 2028. So you could just potentially let it ride if you felt comfortable with this type of business.
And do you have any sense for how they, as I understand it, they're a little bit smaller than some of the other advertising peers, but do you have any sense
Yeah.
of kind of whether that's a disadvantage or an advantage or kind of, whether they should trade at a premium or discount to some of the peers? Because the good thing here is there's a peer set, right? There's like tons
Yeah.
of publicly traded advertising companies. And so
Yeah.
theoretically it should trade, even if you would argue that it should trade at a 15 or 10, 20% discount, it's like at least you have something to kind of hang
Yeah.
your hat on.
And if I remember, Omnicom, Interpublic, they're tying up, right? So you have like two huge players that are coming together through a merger. So that leaves these guys way smaller on the spectrum. So yeah, I don't know. I don't know if it's an advantage or a disadvantage, other than M&A could be more fruitful for them or more needle moving. But I don't know if they'd be interested in, with two big dogs coming together. It makes you wonder if they should tie up with another big dog, right? And like try and move up that rung to become larger. But I'm guessing they'll just keep doing these little tuck-in deals, and you're kind of reliant on, can they create value with that? Like these serial tuck-in acquirers. Like it should be pretty obvious right out of the gate whether they're creating value with it over time. And this one, you're like, all right, I don't know yet. I don't have a good sense for whether M&A is really creating a ton of value here over the last few years, at least.
Interesting. Yeah. Um, okay. Yeah. This one continues to be interesting. I feel like all the Vivendi spinoffs have been interesting, and I haven't pulled the trigger on any of them. I was initially more excited about Canal Plus.
Yeah,
But then it was like a little bit harder for me to wrap my hands around that one.
a
And
little. Yeah,
and then Havas, it seems just a little bit more easier to understand, but I think I got to spend some more time to understand the nuances of the international accounting
yeah.
standards.
The Canal one I thought was really interesting too. And then when I found they were like doing this, basically a mega acquisition, right? I mean, it's like a substantial change in the business after that acquisition closes, the multi-choice thing. And I looked at it, I'm like, oh man, I don't know that I can underwrite this very well. So I just want to like give them some time to like close that, figure it out. What does this thing look like? I don't know. I haven't followed it as closely after the spinoff though.
Yeah, I think talking to you kind of made me it made me think a little bit harder about that because I think everybody was saying, "Hey, they got to close this multi-choice acquisition. It's going to be a major positive because it'll accelerate growth and give them this access into this African market that's growing and has really good demographics."
Yeah,
But I think you brought up like, "Hey, but then it's Africa, and then you have currency. You have big, big, big currency risks, right?" And
totally.
I've a name that I've you recommended in the past and still own is Airtel Africa.
Yeah,
That's a really, really cheap business with tons of secular tailwinds. But the currency, it's moderating recently, but it's been a massive headwind, right?
yeah,
And
yeah,
so those are the two offsets. You have the amazing demographic tailwinds, but then you have the currency headwinds over time. And so
yeah.
yeah, made me kind of second guess that as well.
Yeah, yeah, absolutely. And I think that after that multi-choice business, I think it kind of fell off a cliff, right? I just remember reading one press release as I was looking at it, and they were like, "This is the hardest environment we've ever been in our entire history." Like, oh my gosh, this is terrible. Like, anyway,
One other name that I wanted to talk about, and I didn't preview this with you, so we'll see if you spent any time on it. Have you
sure.
looked at the Resolute Holdings
Oh,
spinoff?
yeah, I haven't looked at this one. It's I've like read about it, from afar. This is the one where it's like, hey, you're basically creating like a fund for this guy who's got a track record to go out and like create some value, right? Like that's
Yeah, so it's really, really interesting.
high level that's the thesis. Yeah.
So CompoSecure is a business that I think they're most famously known for. They make the metal cards. So they made a gold Robinhood card. They make I think the Amex Platinum card. So
Yeah.
they specialize. They have this like niche um, market expertise in making metal credit cards, which I think, look pretty cool. It's a cool thing for branding. Obviously, they're much more durable than the plastic cards. And so, arguably there's a growth market there. And then this guy, and I'm blanking on his name. So his background, he came from so it's David Cote. He came from Honeywell, and his background is, he's a really good track record of doing
M&A
really
guy.
creative M&A.
Yeah.
Exactly. Good M&A deals. And so he came in and he said, "Hey, I'm going to invest in CompoSecure. I'm going to invest whatever it is, $500 million, $600 million. I forget the exact number. But like, I'm going to basically I'm going to share my M&A playbook with CompoSecure, and anything that's in niche manufacturing, industrial manufacturing is fair game."
Yeah.
And then they said, "Hey, we're going to spin out this business called Resolute Holdings, and the business is going to just be an M&A advisory firm for CompoSecure." And the way that Resolute Holdings is going to make money is they're going to get basically, I think it's like, let's see, like 3 or 4% of EBITDA on an every quarter from CompoSecure. So basically, they're getting a percentage of CompoSecure's EBITDA to
Yep.
fund them. And it's going to work. It works out to about $50 million of revenue initially that Resolute Holdings is going to have. And then Resolute Holdings cost structure, they have a bunch of, expensive executives that are going to kind of focus on M&A, and that they're going to call their cost structure is going to be about $15 million a year. So there's going to be no earnings really for the next year or so.
Yep.
But the bull case is that basically Resolute CompoSecure could do crazy M&A, and I think they have about 150 million of EBITDA right now.
Yeah.
Say they're able to like grow EBITDA to uh a hundred or $1 billion within 5 years. Then, in that scenario, CompoSecure could have, or Resolute Holdings, could have $100 million or
Yeah.
so
Huge upside on
of revenue, of really high margin revenue. And then this is an alternative asset manager, and it's trading at a really, it should trade arguably at a really high multiple. So that's
yeah.
kind of like the bull case scenario, but
Yeah.
it's been hard. It's been crazy volatile, even in the when issued market. And because on the one hand, I think the market cap right now is like $300 million. And you're like, hey, if I can buy a business that David Cote kind of controls for $300 million, that seems like a great deal. I guess I just don't have confidence. I need to better understand like how realistic, if CompoSecure is going to do a ton of M&A
Yeah.
and going to grow EBITDA significantly, then I think Resolute Holdings is a buy, like just buy it. But I just got to better understand like how much CompoSecure, how much M&A is feasible for them. And so that's kind of the thing that I'm trying to dig into.
Super interesting. And it kind of feels like a REIT or a BDC with an external manager, like,
Exactly.
you know,
Exactly.
I think back to the FNFV, if you remember that spinoff from like 10 years ago. I can't remember the name of the guy, Fidelity National Financial. There
Yep.
was a guy, who was this had kind of a similar thesis, but he did it all within that one public company. Um, yeah, I don't know. It's interesting. And it sounds like Compo has all the incentive in the world or sorry, the Resolute has all the incentive for Compo to go like issue equity, tons of equity, right? Like just grow that absolute dollar EBITDA line, like at all costs.
100%. That's the incentive, right?
Yeah. Which is
Yeah,
kind of
that's the
scary.
incentive.
Yeah.
And I guess it's kosher because everybody had access to the spinoff, right? Everybody
Yeah.
who's a shareholder got spun off their pro rata, right? So
Yeah.
even
Yeah.
though like values accruing in the scenario to Resolute Holdings, it's like
Fair
it's
game.
fair
Yeah.
game. Like
Yeah.
and it's exactly right. It's like an external manager. It's like, hey, we're gonna have an external manager, but you're gonna own the external manager. So it's really fascinating.
Hey, I actually have to run. I gotta go hop onto a 10:30. I'm sorry.
No worries. Yeah.
Okay.
This is amazing.
I
Colin,
love the
thank you.
free flowing. Yeah, I love the free flowing stock talk. Yeah.
Yeah, we'll have to do it. We'll have to do it again. We'll see if there's any feedback, and we'll do it again. But Colin, really appreciate the time.
Yeah.
We'll chat spin off soon.
Round three. I love it. Let's do it.
Awesome.